This is FinTech Insider News. This week, lending rules loosen as HSBC offers mortgages at 6.5 times salary. US open banking on hold as a judge temporarily blocks the CFPB's rule. And over half of British adults are now using AI to manage their money. We take a closer look. We'll be discussing all of this and more on today's show, so don't go anywhere.
When it comes to your card program provider, you can't afford to compromise. Marqeta's modern payment solutions flex with your business without the trade-offs. Stable and agile, secure and innovative, scalable and configurable. If somebody tells you that you can't have it all, don't believe them. Your business and your customers expect more. So choose a partner that delivers more. Choose Marqeta. Learn more at marqeta.com/11FS.
Does moving money across borders feel scary? This episode of FinTech Insider is brought to you by 3S Money, a fintech scale-up that makes global payments simple, predictable, and human. With 3S Money, your business gets multi-currency accounts and local IBANs, enabling you to send and receive payments in all major currencies, reaching the widest possible range of destinations. You'll also have a dedicated account manager, a real person, not a chatbot, guiding you through every step of the way. Enjoy the best FX rates, fully transparent fees, and premium service backed by regulation you can trust in the UK, Luxembourg, UAE, and Hong Kong. Go global with confidence. Open your account today at 3s.money and find out more.
Hello and welcome to episode 1013 of FinTech Insider, brought to you by 11FS, the 5-time consultancy of the year that works with banks, digital banks, investment firms and fintechs, building the next generation of financial services. I'm Benjamin Ensor, Director of Research and Strategy here at 11FS. This week, we celebrated Bonfire Night here in the UK, and as the tradition goes, fireworks lit up the skies across the country. Another area bursting with activity this week is the world of fintech, with many stories igniting widespread interest. Helping me sift through the sparks and the smoke is our panel of fintech experts, so let's meet them. First of all, a very warm FinTech Insider welcome to Germain Barry, co-founder and Chief Growth Officer of Zazu. Welcome to the show. Now, I gather Zazu is at a very exciting time. Can you tell our listeners a little bit more about it ahead of the launch, please?
Yeah, sure. Thank you for the invite. It's a privilege to be here with you guys. A little bit about Zazu. So we are building and launching very soon a business banking stack, basically for African entrepreneurs and SMEs. Probably the closest model that you know in the UK is Tide, or the Mercury of Africa, as we've been called, where we basically helped entrepreneurs simplify their everyday banking. Right, by being able to pay and get paid, but also manage things like bookkeeping, invoice management, spend management, everything in one place. Yes, so we are looking at 2 markets at the moment. The first one is South Africa, where we are live with a small pilot, and Morocco, where we will be launching in the coming weeks, and with a bigger and larger announcement probably around December.
So launching at both ends of the continent. Fantastic. We also have a FinTech Insider debut for Ian Armstrong, Executive Director at ComplyAdvantage. Welcome to the show, Ian. Can you tell our listeners a little bit more about you and a little bit more about your role at ComplyAdvantage, please?
Thanks so much, Benjamin. Really, really pleased to be here. I'm a long-time listener, you could say. So my background before I joined ComplyAdvantage really is in financial services for getting on for 25 years. So I was originally in the enforcement division of the regulator here in the UK. And after just under a decade of that, I moved into banking. So I was at Barclays, followed by HSBC, followed by NatWest, where I ended up as the head of risk of metal and NatWest Boxed, before NatWest Boxed had a name. So I've been at ComplyAdvantage for just around 3 years, and my role at the company is really a kind of cross-functional role that cuts through commercial, product and marketing. And really I'm trying to use my background in the industry to help effectively any member of staff in the company to understand the needs of our users, so the needs of compliance teams, risk managers, etc.
We love a bit of customer needs focus, so fantastic. Welcome. And I'm also delighted to welcome my colleague Rosie Lee, Senior User Experience Researcher and Customer Strategist here at 11FS. It's great to have you with us. Could you introduce yourself to our listeners, please?
It's great to be here. Thank you for having me. For those listening at home and for our guests, I'm Rosie. I'm a senior customer strategist at 11FS. So really, I just spend my days talking to customers, understanding what they need, taking those insights to banks and financial institutions, helping them to improve their products and services, and ultimately improve customer experiences. And I'll very much be bringing that perspective to our discussions today.
Fantastic. Welcome. Okay, well, let's get into the news. So we're going to start with a story from the UK that may bring a little bit of déjà vu to some of our listeners, which is that HSBC is offering 6.5 times salary mortgages as lending rules begin to loosen. So HSBC is now offering its premier clients mortgages of up to 6.5 times their salary with at least a 10% deposit, the highest ratio from a British lender since the 2008 financial crisis. The move coincides with a review of the lending rules that were brought in to prevent a repeat of the risky borrowing that preceded the 2008 financial crisis, encouraged by the British government, which is trying to help more people get onto the housing ladder. So this shift also signals growing competition among lenders to try and stretch income multiples amid pressure from the government to stimulate the housing market. Separately, another UK lender, Nationwide Building Society, has announced on Monday that it's expanding its range of interest-only mortgages. Meanwhile, over in the United States, Robinhood Gold subscribers are now able to access discounted mortgage rates and closing credits through a partnership with digital lender Sage Home Loans. So there's a lot to unpack here. First of all, perhaps maybe come to you, Rosie, first. How difficult do you think it is for people to get a mortgage? Is that a difficult process? Is this justified, lending people more money? Does that help?
I mean, in the past we've lent customers more money than perhaps they are being lent right now. I do think it's hard to get a mortgage. I myself have been trying to get one recently. And I think that this article, unfortunately, is a bit headline grabbing. It only applies to a small group of customers, high-income borrowers. They're those premier customers that are earning $100,000 a year, or they have the same amount in savings or investments. So it's not really expanding access to mortgages across the board for everyone. It's only providing more flexibility to that more affluent segment. So
you're saying I'm being sensationalist?
Possibly.
Ian, as someone who's worked at the regulator, I imagine you saw sometimes pressure from governments that are trying to achieve economic objectives, and yet at the same time the regulators are trying to make sure that the financial system is robust. When I saw this story, I was like, wasn't sort of generous lending, let's call it that, one of the root causes of the financial crisis, or am I being too conservative?
No, I think you probably received the headline exactly as it was meant to be received. I'm kind of in Rosie's camp on this one. I remember the 2008 period, the global financial crash very well. I was actually at the regulator when it happened. Not to mention the years immediately after it. I remember it quite vividly. And I think one thing to remember is that prior to that, there were a lot of people, even in this country, who were getting self-cert mortgages. So in other words, they were just certifying themselves as being able to pay whatever cost was involved. So I think, again, I'm very much with Rosie on this. I think as long as there's robust processes for banks to understand exactly what the income part in the loan-to-income equation consists of, I think there's a way to offer these mortgages safely. And it sounds like it is a select group who's being given access to them. But yeah, I think the headline clearly is designed to kind of evoke memories of the 2008 crisis. I think when the next financial crash comes, I think it's much more likely to be driven by, say, the commercial property sector rather than retail or even the private debt industry. And in terms of whether it helps people, I'm not too certain. I think it could potentially help people feel that they have access to a bigger pool of potential properties, right? Because if you're looking to buy a home, you might say, well, I can, realistically afford these 10. With this change from HSBC, maybe that gives you access to another 5. If the bank's given them assurances that they're eligible for that level of lending. So it might help to, stimulate the growth agenda, to your point.
Shemaine, I'd love to bring you in as well. What do you think of this? Do you think we should be welcoming a sort of loosening of lending standards and sort of more people being able to sort of borrow more? Or should we be a little bit nervous if lending standards get loosened too far?
Look, I'm just as a disclaimer, I don't think I'm the mortgage specialist, but looking at both continents, right, Europe and now Africa, where I'm spending most of my time, we definitely see a lot of the same processes, right, that are still very lengthy, that are still very much paper-based, even more so here. So that brings, as Jan said, right, lots of problematics around access, particularly around, self-employed, the gig economies. A lot of actually of the to a certain extent, some of the business owners as well that will be serving. So look, I think there's definitely an opportunity here. I think that's where, probably some of these headlines now are on point. It's probably the next wave of innovation, especially when it comes to data and alternative source of data. We're starting to see it here as well in South Africa, where you're seeing more and more marketplaces. You're seeing more intelligent tools to serve that. So I do think there's a need for reviewing some of these processes and a better sort of assessment and scoring models, which were basically the traditional models are still not yet a fit.
You make some really, really interesting points there. I mean, Rosie, I'd love you to sort of reflect on that a little bit, because I'm sort of looking at HSBC and thinking, well, are they offering to lend more to sort of try and compete, sort of try and make themselves more attractive? But actually, as borrowers, as customers, people trying to buy houses and so on, are people looking to borrow more, or are they looking for an easier process? Are they looking for both of those things? What do borrowers want from the mortgage market, do you think?
Well, they're really looking to kind of live in a home at the end of it, aren't they? So I think the concerns come around, creating a bit of vulnerability in borrowers. If they're borrowing so much more than their income, it helps them to get on the ladder. But then are they less safe if interest rates rise, incomes drop, living costs increase? They've got less room to maneuver. Nationwide's doing a similar thing with their Helping Hand scheme, which is allowing first-time buyers to borrow up to 6 times their income, but only if they have a solid credit profile. So I think it's part of a broader pattern, a broader theme from banks, and they're experimenting at the edge of that regulation. But they're only prioritising the customers that are at the least risk.
So both HSBC and Nationwide are sort of doing the same thing of saying, for certain customers in certain situations, we'll lend you a bit more. But I suppose, Ian, coming back to your point about self-certified mortgages, that feels quite different to the self-certified mortgages where I say, I'm earning a huge salary, so lend me lots of money, even if I wasn't.
Yeah, absolutely. I do think, we sort of live in different times now. Definitely take the point that there is always that risk if you kind of increase the amount you're willing to lend to a person that they are going to default on that. I do definitely think there are better controls in place around that kind of thing right now. And probably what we'll hear, in a few months' time is stories about people who were not able to access these mortgages. They were turned down for them. That would not surprise me at all.
I suppose all of us who lived through the global financial crisis have a kind of sort of instant reaction to anything that sort of smacks a little bit of a sort of return to some of the sort of the worst practices that sort of helped to trigger the financial crisis. Okay, well, let's move on to our next story, which is that ComplyAdvantage has launched an AI-native platform to combat surging financial crime. So ComplyAdvantage has launched Mesh, which is an AI-native system that brings together customer and company screening, transaction monitoring, risk scoring, and real-time payments analysis. Built on large language models and predictive machine learning, Mesh uses agentic AI that can learn, act, and adapt across the full compliance lifecycle. The launch responds to reported surges in AI-enabled financial crime over the past couple of years. According to Celent, a research company, banks report anywhere between 75% and 90% false positive rates across their fraud and AML transaction monitoring systems. So Mesh by ComplyAdvantage aims to cut the number of false positives by up to 70% and speed up investigations, turning compliance into a competitive advantage through faster onboarding and smarter transaction processing. Ian, so congratulations on the launch. It's great to have you here to talk to us about it. Tell us a little bit, what does it mean to have sort of AI native in a compliance platform? I mean, compliance teams have been using AI for a while, right? How is Mesh different from what firms have been doing up till now?
Yeah, it's a really fair question, and it is an important distinction because I think, honestly, there is a lot of noise out there in the market right now with basically everyone and their uncle claiming to be AI-powered. So I'll try and be as specific as possible about what we mean. So traditional anti-money laundering systems, and I've seen plenty of those in my time, were designed really in an era of batch processing, on-premise systems, rule-based logic. So when some activity or customer attribute triggered a rule, it created an alert and a human investigated it. Fine. What a lot of vendors out there have done is essentially apply a layer, a bolt-on of AI on top of that type of architecture, perhaps using machine learning to score alerts or to prioritize alerts in a queue. Don't get me wrong, that is helpful, but it's fundamentally limited because the underlying infrastructure wasn't really designed for it. And so you still lack an understanding of context. That's why you end up with those very high false positive rates that you referred to. It always staggers me when I hear stats like that. But I mean, they're absolutely accurate in my experience because people still have these data silos. They're still effectively copying information from one system to another. And so the AI is trying its best, but it's essentially an add-on rather than integral to how the platform thinks, if I could use that kind of language. So what we've built with Mesh is genuinely different. It's 3 adaptive layers with a kind of common operating system. So at the foundation, the thing that breathes fire into the whole thing is our proprietary intelligence and data layer. So that's continuously ingesting data from out there in the world, from things like sanctions lists, from media articles, from government warnings, and then on the other side, from our clients, so transaction patterns in their customer base, customer attributes from their CDD processes. And that first layer really is imbued with AI from the outset. So there's use of LLMs in terms of how we process documents and classify them according to what we call our risk schema. There's sophisticated machine learning involved in how we resolve entities. So that's, in other words, how you say, oh, this person here and this person here is actually the same person. So that's entity resolution. That is driven by artificial intelligence. And on top of that are what we call our risk applications. Our risk apps sit on that. So these are things like customer screening, transaction monitoring, payments analysis, But critically, they all draw on this same data model, the same entity resolution, same knowledge graph. So when a client of ours is investigating a customer, they're not switching between 5 different systems with different views of the same person. It's one unified intelligence picture. Now, there are vendor solutions out there that try to orchestrate different systems. But the overall effect isn't the same because they're effectively trying to get, say, 3 or 4 different things onto one page. They're not really doing too much to kind of integrate them or make those 4 different things talk to one another. And then the third layer, and the third layer with AI also imbued into it, is we've introduced our first user-facing AI agent, who we call Cassie. I say first because there are a lot more in the works already. And I say user-facing because we have a load of agents that we use for internal processes. But what Cassie does is orchestrate workflows across the entire platform. So rather than an analyst manually gathering information and cross-referencing databases, documenting findings and making a decision on a case, Cassie can execute that entire workflow autonomously for lower risk cases and surface the genuinely complex things that need human expertise. So in short, AI native system, the entire workflow from data ingestion through to investigation to disposition is designed around what AI can do well. And the idea is that humans are then freed up to focus on what they can do well.
Amazing. Germaine, I'd love to bring you in here. As you think about sort of starting operations in South Africa and Morocco, you'll be doing lots of good for all sorts of businesses, but also presumably there'll be a few bad actors. There'll be a few bad people trying to get in and take advantage of you, take advantage of your systems, people who shouldn't be there or doing things they shouldn't be doing, and so on. What do you think of sort of AI platforms like Mesh? I mean, are you thinking about this sort of thing to try and protect yourselves from bad actors?
No, definitely, and that's again even more so a topic in Africa, a rising one. And this is where also there's a big wave of new compliance softwares and so on. The likes of that's the earlier version of ComplyAdvantage. I remember the times when RegTech was not even the word, and ComplyAdvantage came in. So we're seeing a new wave on the continent coming in to solve exactly these points. That is true that indeed in our early days when we started operations, we did feel that it was the experience was quite fragmented to find a software specifically for identification, AML, and so on, and then everything around transaction monitoring and so on. So definitely a need. This is where also that's typically a big use case for us in the application of AI at the operation level. Obviously, there's another big use case for us, which is around specifically customer facing, but definitely something we're looking at, and definitely something we want to invest more. Specifically, as I said, in region where both we know that hackers have been very successful, very active. Right, Nigeria is one is a market that we're looking at, where in the meantime we've had a lot of very successful fintech and that managed to scale it, quite importantly. But in the meantime, we're exposed to certain fraud and hacks. But also, you'd be surprised in some markets as well, where the banks don't always welcome certain fintechs, and one way
the ones that compete with them, yeah.
Exactly. You know which ones, but that sometimes may have some misintentions and try to even poke or hack the system. So definitely relevant more than ever.
And Germaine makes a series of really interesting points there, but one of them is that strikes me as the differences between countries, right? Because we know that one of the challenges with sort of know your customer, anti-money laundering, fraud, and so on is that just different countries have different systems, and even things like the frequency of surnames or family names mean that in some countries it's much harder to identify an individual than in another, because if you've got 20% of the population share a family name, it's much harder to tell individuals apart. Are you finding, Ian, that that sort of AI is sort of helping with some of those sort of, country-specific challenges where, some countries you've got some really quite good data about who people are, and other countries you just haven't. Are you seeing different outcomes?
No. I think we're somehow we're still complaining about Europe not being fully standardized, but I think we've came quite a long way, especially when you look. Indeed, I use loosely Africa as a continent, but indeed you can separate it in regions and then definitely look at country specific. And within some countries you have areas or sub-regions where you have different almost jurisdictions. South Africa being one, but indeed you're looking at different types of level of digitization from the government, different types of ideas. Morocco, luckily enough, has been pushed by the government around a full digital ambition, including the idea of having an eKYC system and digital identification. So that's something we can definitely piggyback. But indeed, that is something where, as I said, we that's one of the key criteria that we're looking at when we partner and we're looking at specific vendors, is to make sure that some of them, luckily enough, have developed across certain regions and have developed these specificities and local flavors. But it remains a challenge, specifically around indeed identification, things like this. And this is where also I think AI has brought up a big leap where I think a lot of whether it was false positives or specific processes were still at some point flagged and then manually reviewed. Where now we are able, and this is where we can get an edge, still in countries like Morocco and South Africa, where the banks are quite developed. But if you look closer at certain internal and operational processes, where we can definitely be more efficient.
Thank you.
It's a really interesting point that you made, Ben, about the kind of prevalence of different names and the way names are structured and things like that playing out differently, in different parts of the world. Because that is absolutely one of the kind of core contributors to the problem, if you like, of name screening and those false positives that you referenced earlier. Another thing that we've done in the course of building Mesh is to look at name commonness. So it's very much trying to address the point that you've just made, which is in a particular country, let's say, or region of the world, certain types of names, certain names are just going to be more prevalent. They're going to be more common. The example I give is when I first started, the first bank I worked in, there were 3 people with my name in the same building. So there was I thinking I had an incredibly unique name, but in fact I was sort of brought crushingly down to earth when I realised that it's actually a really common name. And yet if I were to go to, I don't know, a country in, say, Asia Pacific, it would be a less common name. So our models, our kind of search and match models, have been trained on that type of commonness. So they're hopefully able to detect that this name in this country is relatively common. And so when they're trying to match against, say, a sanctions listing, that's part of the calculation when they are calculating the likelihood that this name of your customer is the same as this name of, say, a sanctioned individual.
Presumably you've been sort of testing and deploying Mesh into different countries presumably with different clients. Are you finding any sort of differences between countries? Are you finding that it's just a bit quicker to sort of reduce false positives in some countries than others, or are you finding it's performing similarly? I'm just curious, are you noticing any differences in the system in different countries?
It's a great question. So we've rolled it out, I think, to 200 or 300 clients at the moment. Now, I must confess, I haven't seen the exact country coverage of those clients. We have clients in our entire base in over 90 countries, I think. So we've learned a huge amount. ComplyAdvantage has been running for 11 years. So in that time, we feel we've really kind of earned our seat at the table. We've learned what works, what doesn't. And to your point, we've learned a huge amount about what works in specific markets. So I think it's possibly a little bit too early to say, because we're quite, we've only really recently launched it in terms of those variances. But as I say, the way the models have been trained, it is hopefully going to make it so that wherever you are in the world, you'll see immediate benefits from using the tool.
One other quick question for you on this. Fraudsters and criminals are sort of notorious for actually being increasingly international. I mean, obviously, there's sort of low-level fraudsters who are just, attacking people in their own country, but there's a lot of international fraudsters. Is the system sharing information across those clients, right? Because let's imagine Rosie's an international criminal. She's probably attacking lots of different clients in lots of different countries. Are you sort of sharing? Is the mesh system sharing data from different clients so that the second bank that Rosie attacks says, "Hang on a minute, we've seen her before." Is that how it works?
Not at the moment, no. I would very much say watch this space on that. I think that type of data sharing is something that we are extremely interested in. Now that we've got this unified platform, I think it definitely opens the door to that type of module or that type of functionality. Because, there is a huge amount of interest in it. I think historically, it's been, it would have been quite difficult to do that, firstly. And secondly, of course, the big concern there is always around PII, so how you handle personal data, which can be fraught enough in one country, let alone doing it across borders. But I think there is a lot more appetite from both the industry and, in fact, regulators, governments for that type of data sharing. So I would say watch this space on that.
Fantastic. Well, congratulations to you and your team on the launch. Okay, we're just going to take a quick pause here and we will be back very shortly.
What's going on? I'm Arch Manning, Viore athlete and college quarterback. Whether I'm running, training, traveling, or just unwinding at home, I love doing it in my core shorts from Viore. With a breathable boxer brief liner, they're quick to dry, super versatile, and stand up to even my most intense training sessions. Plus, they come in 3 inseams and a ton of colors. Ready to try a pair? Go to viore.com/arch and get 20% off at checkout. I think you're going to love them as much as I do. That's viore.com/ARCH and get 20% off your first order. Exclusions apply. Visit the website for full terms and conditions. Not only will you receive 20% off your first purchase, but enjoy free shipping on any U.S. orders over $75 and free returns. Have a great day.
Hey there, it's Dr. Sanjay Gupta with some exciting news to share. CNN is now streaming. That means you can read, watch, and stream everything in one subscription. You can watch news live 24/7. You can also explore catch-up videos and explainer videos, and you can also watch a library of CNN's originals, including my latest documentary, It Doesn't Have to Hurt. Just go to cnn.com/all-access.
Before we dive back into the news, a quick word about our latest Insights episode. This week on FinTech Insider, Ross Gallagher and Tim Hurd from 11FS sit down with innovation leaders from NatWest, Santander and Lloyds to understand how UK banks are modernising at scale. We're talking about real-world innovation, shaking off legacy systems, partnering with fintechs, empowering teams and experimenting faster, all while keeping risk in check. Get the inside scoop on how banks are using agile delivery, data-driven decisions, and leadership alignment to drive the next wave of fintech growth. Tune in and see what it really takes to stay ahead. Whether you're leading a compliance team or just curious about the forces shaping financial regulation, this episode is packed with insights on turning a quieter sanctions cycle into a smarter strategy. Find it in the same podcast feed as this one. Back to the news. So, AI fintech Optasia has listed in South Africa. So the UAE-based lending fintech Optasia has listed on the Johannesburg Stock Exchange, or JSE, in one of South Africa's largest fintech initial public offerings, and the largest seen on the continent this year so far. Optasia's AI-powered platform extends airtime credit, microfinancing, and digital financial services to more than 120 million people across 38 countries, processing more than 30 million loan transactions daily. The IPO raised approximately $372 million US dollars, covering both primary and secondary shares, and the company's valuation jumped to around $1.3 billion post-listing. South African bank First Rand acquired a 20% stake in Optasia via an off-market transaction, signalling investor confidence in the Johannesburg Stock Exchange and the region more widely. Germain, let's come to you first. This is a big listing. It's one of the biggest listings in Africa so far this year. It's pretty exciting. Why do you think Optasia went for South Africa rather than maybe going to London or New York, sort of bigger markets? Is this exciting? What do you think?
No, I mean, the fact that we're talking about it, right, on the UK or European podcast, it makes it exciting for that part of the world, right? So I think and I think for the space in general, particularly financial inclusion and everything around microfinances and but that's really shed lights on the fact that these are models that can actually be executed and brought to IPO, right? And Time Bank is probably another name that you've heard of, right? That have demonstrated that. So why South Africa? Well, they were present in South Africa and in the region, right? So I think it's probably something symbolic, right, to really be aligned and show credibility with their story, right, and their commitment to the region, as opposed to chase Western valuations. We've seen the likes of Jumia, for example, the Amazon of Africa, listing in I think that was the New York Stock Exchange or Nasdaq, but and at some point down the line, backfiring to them when it comes to certain market conditions and so on, right? So, I think overall it's a message of confidence, as you rightfully said, and also I think, well, let's face it as well. South Africa and the South African Stock Exchange is the Johannesburg Stock Exchange is quite a developed and robust marketplace where they have experience with similar players, right? And I think they understand more than any other stock exchange or investor hub, I guess, the context and the risk that goes with this business model. So I think overall positive, and I think a big message to show that that part of the world can also handle a tech IPO.
Fantastic. Rosie, what do you think about the opportunity for fintechs in Africa? Do you think there's still lots of opportunity for fintechs?
Of course, yes. So much opportunity. It's an underserved market, and it will only help small businesses that are struggling to raise finance, making it easier for them to borrow and set up their business. Of course, there's an inclusion angle here as well, helping those in poverty to rise out of poverty, rely less on cash. Very, very cash heavy there. And also there's also a financial education angle here too, in that when a company is using AI to make lending decisions, customers, of course, still need that reassurance about how their data is being used. So the success of this will ultimately depend on whether customers feel like their decisions are being made transparently and fairly.
Just to add a note on that, no, I completely agree, and I think you've seen so as you've seen in Europe and the UK, right? You had multiple cycles before, before I don't know if Monzo or Revolut went public, but at least they certainly announced at some point, right? So Africa is, to a certain extent, they've bypassed certain aspects of fintech, but you've seen a lot of winners like Moneypoint, like Time Bank I mentioned, Flutterwave, that are now scaling and becoming, actually they become some of the first unicorns on the continent, have been considering IPO, but the path hasn't been a clear one. Historically, the IPOs were really reserved on the continent for, I would say, mining and big telcos. But now the path that Optasia has shown makes it tangible. And makes these companies like Moneypoint, Flutterwave, that were on the verge, that were considering it, a realistic scenario.
I agree. I think it's really, really exciting. I mean, the sheer number of customers that they're working with, 120 million customers, because we get excited about sort of, I don't know, Nubank or WeBank and so on, because, they're serving that sort of number of customers. And I realize that some of those customers maybe not as wealthy as the customers in Brazil, who are themselves not that wealthy, but still 120 million people is a sort of huge number of people being helped with credit, with airtime, and so on. Ian, what do you think? I sometimes feel that Africa is neglected by Europeans, that we don't pay enough attention to what's going on there. What do you think of this story?
Yeah, I completely agree with that assessment. I think, it's easy to forget that, M-Pesa, which was one of kind of the original financial innovations, came out of Africa. What I'll say, we have a number of African fintechs on our books as well. And there's some of the most interesting and not to mention fun ones to work with. What I'll say is anywhere in the world where you get significant amounts of migrant work corridors, so people moving out of one country into a neighbouring country or country nearby because there are better job prospects, etc., and then sending money back to their country of origin. What you'll see there is a lot of remittance activity, which is absolutely ripe for disruption and is, being very actively disrupted in all parts of the world where you get those types of corridors. We also do a lot of business in Asia Pacific and, some incredibly innovative remittance fintechs that come out of that region. So, and we can see the same thing happening in Africa, and I actually don't think it's got up to full speed yet.
Yeah, I think there's a massive opportunity, isn't there? Germaine, what about South Africa? Is South Africa very much the capital of African fintech? So, I mean, you're talking about how other African fintechs may come to IPO, and they may IPO in Johannesburg. This is a kind of an obvious question, but why South Africa? Why Johannesburg? Is it the capital of African fintech still? Or what about Nairobi? Or Cairo?
Yeah, very true. I think you've seen some very big momentum. I think when it comes to, so I think the way I look at it is, you have big hubs like indeed Kenya with M-Pesa for mobile money. I would say Nigeria as well. I mean, it's more than 300 million inhabitants. I mean, that's the size of the US, right? With I think average people with almost less than 25 years old. So you have huge promises for sure, and you have entrepreneurs. You have a whole new generation of entrepreneurs that are hungry. So lots of opportunities for sure. South Africa has seen, it comes from a difference. It's a bit more developed when it comes to financial infrastructure. So actually, you have less of a topic of financial inclusion. You do as well. You have a number of unbanked people, but people have bank accounts, at least in South Africa. So I think from a robustness and maturity of the financial market, I think that's definitely South Africa is the right place. I think from the credibility and the validation from the international scene, and the stability that South Africa brings as well. I think talking about Nigeria and Egypt, you've seen quite some volatility in terms of currencies as well, right? So you have specific investors that are in there. So I think for all these reasons, I think South Africa and the GSC is definitely ripe for the scale and the I guess the regionality of that IPO.
Fantastic. Well, I hope you're right that we're going to see a lot more African fintech IPOs over the next few years. It's very exciting news. Okay, let's move on to our next story, which is that over 28 million adults in the UK are now apparently using AI tools to help manage their money. So according to Lloyds Banking Group's latest Consumer Digital Index, around 28 million adults in the UK, or 56% of the population, report using AI tools over the past year to manage their personal finances. The most common uses include budgeting, savings planning, financial education, with 37% using AI for investment advice, 26% for debt strategies, and 39% for retirement and pension planning. Customers estimate that the insights from AI have helped them save £399 per year on average. Despite widespread adoption, 83% worry about the privacy of their data, 80% worry about receiving inaccurate information, and 69% are concerned about the lack of personalization. Meanwhile, a similar study from Adobe found that over a third of American consumers have been using AI for shopping. Rosie, let's come to you first. These are quite high figures. Are you surprised by just how many people appear to be experimenting with AI, or am I just showing my age?
I thought we talked about this, Benjamin. I thought we said we need to use it more. No, I'm not shocked by how much they're using it. I think that we're seeing the same in our own testing that we're doing with customers, that they're very much wanting to use these tools to manage their finances, to learn more about their money and be more financially resilient and stable. But they're just not quite ready to trust it. They're quite apprehensive at the moment, and they are only ready to trust it once they can see the outcome. They can see what it can do for them. They then will start to trust it. And for me, the most interesting part of this article was that the study found the link between digital confidence and financial confidence. For me, that really was the most interesting finding from this study. And within our own testing, a lot of customers still refer to AI as a robot. And I think it's really telling for how they're viewing digital technologies, especially AI, viewing it as impersonal and inauthentic. And the findings that Lloyds have found really echo the findings from our testing. In a recent focus group that I ran, 2 participants said that they couldn't trust the bank and the AI tools because they didn't know whether their data was going to be kept safe. And so I think the challenge for banks is not just building the tools, but building that confidence and that comprehension around them. And I also think that's why what Lloyds is doing is so interesting, by offering free digital training through the Lloyds Bank Academy, because it's helping customers build both digital and financial capability. And I really do think it's the responsibility of banks and financial institutions to educate their customers. And ensuring customers understand what's happening is how we can close that trust gap between humans and AI and ultimately improve financial literacy.
Ian, I'd love to know what you think, particularly as a sort of former regulator. I mean, 37% using AI for investment advice. Did that give you a panic attack as a former regulator?
Maybe a little bit, a mild one. I think obviously the devil's in the detail. It kind of depends on a few things. It sort of depends how seriously they're taking it. I mean, I think the £399 figure, was it? I think that's quite credible. It's, what is that, sort of £35 a month. I could definitely believe that. I'd love to see a bit more of a breakdown about how it's been derived. I mean, at ComplyAdvantage, we're all for any story that shows some actual tangible, measurable outcome from the use of AI. And again, I mean, Rosie, you make some great points around those structures that I think we will need to see in place, right? If we're all going to fully get on board with this and for people to get comfortable, it will have to be, I can definitely see us getting to a time where there is some sort of commonly accepted form of warning or consent, before you enter into, and possibly multiple times before you enter into a certain type of AI usage. I'm thinking something a little bit like cookies. The problem with cookies is I think we're all just used to just clicking either yes or no, and not really thinking that much about it. But I think if there's some sort of mechanism like that in place, but no, I mean, it was a fascinating report, and it did call to mind the kinds of thoughts I had when I first started learning about open banking, sort of probably 9-10 years ago. And I can remember giving a talk at HSBC when I was kind of saying, somewhat naively, it won't be too long before our bathroom scales are ordering fruit and vegetable for us and things like that. But I do think we are now a step closer to that. And I'm convinced that open banking has some part to play in this, particularly with that shopping thing. I can definitely see a future where if you allow it to analyze your weekly grocery shopping, you will get to a stage where an AI is saying to you, did you know you could buy all of that exact same stuff from this outlet and save £30? Do you want me to do that for you? Yeah.
Shaman, what do you think? Were you surprised by this? Are you expecting your prospective customers to be using AI?
Definitely, I think we're looking at it with a slightly different angle than Europe. Although I look at a lot of the use cases around Europe, around improving efficiencies and convenience. I think in Africa and many regions of the continent, you're looking at it more from an educational perspective, right? And the ability to make some smart suggestions, but as I said, in a relatively simple and comprehensive manners, as opposed to already getting into a fully automated, back to the topic of agentic AI. I think the technology and the use cases are relatively more nascent. I think, although you're seeing a lot of usage in countries like Morocco, I think I've read once that some of the largest usage of ChatGPT were in Morocco. You're seeing, I think, around 60-20% usage of AI, also tools like ChatGPT in Kenya, right? So it's a mix of. So I think you have back to the opportunity around Africa, right? You also have a huge demographic boom with relatively young population that is mobile first. So you have increasing internet access. So I think there's a huge opportunity to make AI as accessible as ever. So there's definitely something we're looking at and around education and around the ability to really give some contextual understanding of basic finance management and some to a certain degree some predictive nudges, right, to be able to lead later on to more developed use cases around automations and maybe a founder or business owner's co-pilots, right? But I think we're still on the early days of the development wave.
We are. We didn't have enough time to talk more about it, which is a shame because it's such a fascinating topic. But we did discuss AI and customer service in more detail in one of our previous Insights podcast episodes called AI and Banking, What It Really Means for the Customer. So listeners, if you want to, you can find a link to that one in the show notes below this. It's well worth a listen. Okay, now for a quick look at one story we don't have time to cover in full, which is that a judge has temporarily blocked the Consumer Financial Protection Bureau's open banking rule. So a US federal judge has issued a preliminary injunction blocking the enforcement of the CFPB's open banking personal financial data rights rule for now. The injunction was granted in response to a lawsuit from Forscht Bank, the Kentucky Bankers Association, and the Bank Policy Institute, pausing compliance deadlines that required banks to be ready by June 2026. The court-required pause remains until the CFPB completes the reconsideration of the rule. Opponents argue that the injunction prevents banks from having to prepare for a rule still under revision, while supporters say the delay stalls consumers' rights to freely share their financial data. So what's happening here is a little bit of a battle between the sort of Trump administration and the Biden administration, where the Biden administration had encouraged the CFPB to put forward an open banking rule and was rolling forward open banking in the States. And now the Trump administration is now blocking that and has asked the CFPB to rewrite the rule. And so what this ruling does is it means that banks don't have to prepare because it moves the deadline or puts the deadline on hold. The net effect is, of course, to slow down open banking in the States. We've already had changes and lawsuits, and now this is yet further sort of delay to the introduction of any kind of sort of regulatory required open banking in the States. So on balance, this is probably bad news for consumers in the medium term, potentially good news for banks in the short term if it means they don't have to spend time preparing for a rule that changes. But it essentially just creates more uncertainty. We also have a quick update from Marqeta, which is powering an expansion of Klarna debit cards across Europe. So Marqeta is helping Klarna Bank AB to roll out its debit card product into 15 new European markets. The card uses Visa's flexible credential technology, enabling customers to either pay now or pay later using a single card. To tell us more about this launch, we have a quick voice note from Marcin Glogowski, the chief executive of Marqeta in the UK.
This is a significant milestone in the evolution of flexible payments in Europe. Using Visa flexible credentials technology, for which Marqeta was the first issuer processor certified in the US, Klarna consumers get one simple card that gives them the choice to pay now or pay later. It's the flexibility of buy now, pay later combined with the simplicity of debit, all in one seamless experience. This expansion demonstrates the power of Marqeta's end-to-end platform to drive innovation at scale. Through one integration, Klarna is rolling out across 15 European markets, building on our long-term partnership that dates back to 2018. This news also highlights the growth we are seeing in our European business, with total processing volume more than doubling year over year. Adding to this momentum, we recently announced that we have completed acquisition of TransactPay, a BIN sponsorship provider that is licensed as e-money institution. With the combined capabilities of Marqeta and TransactPay, customers will be able to take advantage of card program management features in the UK and EU and avoid the added complexity associated with engaging multiple partners.
Well, we're coming to the end of the show, so just time for something a little bit different from the world of business to finish this week's news show, which is that financial services employees are apparently the least motivated at work, according to a new study. So new global data shows that employees in the financial services industry are among the least motivated at work compared with other sectors. Many workers in financial services report low levels of engagement, feeling uninspired or not going beyond the basic requirements in any of their roles. Key contributing factors apparently include high monitoring and low autonomy in many roles within the sector, which reduce sense of purpose and reduce motivation. The poor motivation levels increase the risk of talent loss from the financial services sector, as disengaged employees are more likely to leave or underperform. I have to admit, I was a bit surprised by that. But what do you all think? Ian, do you think there's some truth in this?
I think it was a global survey, wasn't it? I think, again, well, let's take some of those big banks. Their operational functions often are, outsourced to offshore shared service functions, these sort of enormous buildings where people just spend their entire day, to call back to our earlier conversation, clicking on false positives and discounting them. So you got to think, if that's your job, then I'm not surprised people are demotivated. And having seen that, I mean, joking aside, it is a real problem in those kind of operational roles, is keeping people motivated, stopping people just feeling burnt out from just doing these mindless tasks all day. Like you, I was a bit surprised when I first read it, because I was always massively motivated in my role. But I think what it speaks to is that there is some pretty wide variances in the type of BAU work that people do in financial institutions.
Yeah, that's probably right. What do you think, Germain?
No, as you were mentioning the stats, it brought me back to my early career in not that I had an extensive banking career, but I started in the likes of UBS and so on. So I've seen that set of things, and then slowly moved from more into the scale up world with Fidor Bank back then and Solaris Bank, which were more, in the, as I said, we're not startups anymore, but at least scaling up. And then now, launching my own startup. So I'm not surprised, to be honest. I think, so back to the financial crisis, I think I'm looking at it from slightly different lenses because I didn't live it, right? It's something still theoretical when I was at school. But what I can say is that, coming out of a finance degree back in 2014, 15, I guess, finance was not sexy anymore. Right, you were right away flagged as the, greedy, and all these rather negative connotation types of association, right? And in the meantime, right, it was the early days, if you remember it, of Mondo, I think that was Monzo was called Revolut, right? Where fintech was sexy and cool. Right, and I think probably the wave is stabilizing, but still, I think if you look at people are still very, very proud to wear Monzo hats, Mercury in the US, the T-shirts, and so on. So I think there's a sense of belonging that is key, a sense of impact as well. I think we can see that. I was looking at an interview of Jamie Dimon a few days ago. As much as these old traditional bankers inspired me, I guess, when I was studying, right, because that was the reference. As much as that's not the case anymore, right? I'm looking at tech founders, right? I'm looking at startuppers and so on. I think a big part of the new generation is looking up to that rather. If you look then back at how these talking about banks, I mean, you're looking at hundreds of employees. Just to give you an example to conclude on that, right? I was looking at my boss at UBS, which I think she had worked for 20 years at least in the bank, right? She was a big shot. But still, she as part of the whole machine and organization, she was still a very small piece to the puzzle, right? And when I'm looking at the impact that I had the chance to have at the organization that I worked at, and now more specifically in a startup, you definitely want to wake up in the morning and that you have you're part of something much more dynamic. So I think that's the new generation. I think is rethinking, I guess, those large organizations in general and the association that banking versus tech and fintech has.
Definitely. Rosie, we asked our WhatsApp group the best thing about your job that makes people show up every day. Perhaps you can share with us some of the answers that our listeners gave to us.
The people, which is
your colleagues.
Normal, yeah. Getting to build new cutting edge payment tech, exciting. Helping people figure out how to have a better relationship with their money. That's a good one.
I like the bottom one.
I'm just here to eat the office snacks and play with the office dog.
Fantastic. All right. Well, that concludes this week's FinTech Insider News. Thank you so much to the three of you. It's been fantastic having you. Where can people find out a little bit more about you and your companies? Ian, where can people find out a little bit more about you and about ComplyAdvantage?
Yeah, for sure. So LinkedIn, still the best place for me. Ian with two I's, so IAIN, Armstrong. And for the company, it's just ComplyAdvantage.com.
And Germain, where can people find out a little bit more about you and about Zazu?
They can always find me on LinkedIn and www.get/zazu.com, and they can see a little bit what we're to and our vision to redefine banking on the African continent.
Exciting. And Rosie?
LinkedIn as well, and of course here at 11FS.
And as for me, Benjamin, you can also find me on LinkedIn. So thank you so much for listening to today's FinTech Insider. If you've liked what you've heard, please do follow us, recommend us to your friends, look for us on your favourite podcast platform. Please, if you want to join the conversation, find us on social media, search for 11FS or FinTech Insider, or email us at podcasts@11fs.com. Thank you all so much again. Thank you so much to my three panelists, and goodbye.